While the world watches the skies over the Middle East, waiting for the next headline about tensions between Iran and the United States, a different kind of shift is happening on the ground. It is quieter. It is quieter than a missile launch, but far more permanent. Most investors are looking at oil prices. They are looking at gold. They are looking at defense contractor stocks. But there is a fourth asset class that is quietly surging in value because of this instability. It isn't energy, it isn't ammunition, it is automation. Welcome back to the channel. I'm Alice, and today we are connecting dots that mainstream finance is missing. The geopolitical crisis involving Iran and the US is not just a story about war, it is a story about supply chains, labor risk, and the urgent need for sovereignty and production. And at the center of this storm stands the humanoid robot. Why would conflict in the Middle East make a robot built in a factory in California or Shanghai more valuable? The answer lies in the economics of risk. When the world becomes unstable, human labor becomes expensive. Human logistics become fragile. But machines? Machines are the ultimate hedge against uncertainty. Today, we are breaking down exactly how geopolitical tension translates into valuation gains for the humanoid robotics sector. We will look at the oil shock correlation, the defense tech crossover, and the critical minerals race that powers both missiles and motors. If you are holding positions in tech, finance, or emerging AI hardware, you need to understand this narrative. Let's dive in. To understand the finance behind this, we have to talk about the labor risk premium. In stable times, companies calculate the cost of labor based on wages, benefits, and training. But in times of geopolitical instability, the cost of human labor changes dramatically. When tensions rise in key regions like the Middle East, energy prices fluctuate. We saw this recently with oil markets reacting to threats in the Strait of Hormuz. When energy costs rise, inflation follows. When inflation follows, workers demand higher wages to maintain their purchasing power. This creates a wage price spiral. However, a humanoid robot does not demand a raise when oil hits $90 a barrel. A robot does not need evacuation insurance if a conflict zone expands. A robot does not strike. From a CFO's perspective, during times of global tension, capital expenditure on automation becomes a safer bet than operational expenditure on human staffing. This is especially true for logistics and manufacturing. Consider the supply chains that pass near conflict zones. Shipping routes become risky. Insurance premiums for cargo skyrocket. Companies are now looking for ways to shorten supply chains, what we call nearshoring or reshoring. But bringing factories back to safe zones like North America or Europe is expensive because human labor there is costly. This is the puzzle. How do you reshore production without bankrupting yourself on wages? The answer is humanoid labor. Investors are realizing that the only way to make reshoring financially viable during high inflation, high risk periods is through aggressive automation. Therefore, every escalation in geopolitical tension acts as a subtle subsidy for robotics companies. It forces corporations to accelerate their automation timelines. We are seeing institutional money move away from pure software AI and into physical AI. Software can be hacked or regulated. But a robot working in a warehouse in Ohio, powered by local energy, insulated from foreign labor disputes, that is an asset that provides security. The Iran crisis highlights the fragility of global dependence. Humanoids represent independence. And in finance, independence commands a premium. Now let's look at the technology itself. There is a historical precedent we must acknowledge. The internet began as ARPANET, a defense project. GPS was a military tool before it guided your Uber. Jet engines were perfected during war before they carried tourists. There is always a spillover effect from defense spending to civilian technology. And right now, defense spending is surging globally due to conflicts like the one involving Iran and the US. What does a modern defense system need? It needs autonomous navigation. It needs advanced computer vision to identify threats. It needs robust actuators that can work in harsh environments. It needs edge computing that doesn't rely on cloud connectivity. Guess what a commercial humanoid robot needs? The exact same things. When governments pour billions into defense AI to monitor tensions in the Middle East, they are subsidizing the R&D for the chips and sensors that companies like Tesla, Figure, and Boston Dynamics use. The economies of scale kick in faster. A LiDAR sensor that costs $5,000 for a military drone today might cost $500 for a commercial robot tomorrow, because the defense industry drove the production volume up. This is the dual-use technology thesis. Investors are no longer looking at robotics companies in isolation. They are looking at the supply chain that serves both the Pentagon and the warehouse. Companies that manufacture high torque density motors, harmonic drives, and solid-state batteries are seeing increased demand from defense contracts. This revenue stabilizes them, allowing them to lower costs for their commercial humanoid partners. Furthermore, the AI models being trained for situational awareness in conflict zones are becoming better at general navigation. A robot that can navigate a war-torn street can certainly navigate a cluttered Amazon fulfillment center. The complexity ceiling is being raised by defense needs, and commercial robots are riding that wave upward. So, when you hear about military aid packages or defense budget approvals related to global tensions, do not just look at Lockheed Martin or Raytheon. Look at the component suppliers. Look at the AI chip makers. Look at the battery tech firms. The money flowing into defense is secretly lowering the barrier to entry for the humanoid economy. This is why volatility in geopolitics can correlate with strength in robotics valuations. There's a third layer to this financial puzzle, and it is perhaps the most critical for long-term investors. It is the issue of critical minerals. Humanoid robots are not just software. They are physical entities made of steel, copper, lithium, and rare earth elements like neodymium for magnets. These are the same materials needed for missiles, drones, and defense infrastructure. Currently, the supply chain for these materials is heavily concentrated. A significant portion of rare earth processing is controlled by a single geopolitical entity. When tensions rise, such as the current situation with Iran and its allies, the risk of supply chain weaponization increases. Governments are realizing that relying on potential adversaries for the materials needed to build their future economy is a national security risk. This has triggered a massive push for supply chain sovereignty. What does this mean for finance? It means governments are willing to subsidize the mining and processing of these minerals domestically. It means tax breaks, grants, and guaranteed purchase agreements for companies that secure these supply chains. Humanoid robotics companies that secure their own supply chains or partner with non-hostile nations for materials are becoming more valuable. They are de-risking their future production. Investors are starting to value vertical integration much higher than before. A robot company that just assembles parts is risky. A robot company that owns the rights to the magnets or has partnerships with secure lithium producers is a fortress. The Iran crisis reminds the market how quickly trade routes can be threatened. If the Strait of Hormuz is compromised, oil moves, but so do raw materials. Companies that have localized their supply chains for humanoid production are seen as safer bets. This is driving capital toward mining tech and recycling tech as well. Using robots to mine minerals and using robots to recycle old batteries to create new robots. This closed-loop system is becoming a major investment theme. The geopolitical tension acts as a catalyst, forcing money into these infrastructure projects faster than planned. So, when analyzing humanoid stocks, do not just look at the robot. Look at where the robot gets its blood, the electricity, and the minerals. The companies controlling those resources in stable regions are the ones that will survive the geopolitical storm. Let's bring this all together into an actionable investment thesis. How do we translate geopolitics and robotics into a portfolio strategy? First, we have the enablers. These are the semiconductor and sensor companies. Whether it is a missile guidance system or a humanoid's vision system, they both need high-performance computing. Companies specializing in edge AI chips are crucial. They are the brains behind both defense and automation. Volatility increases the demand for efficiency, and these companies provide efficiency. Second, we have the musclemen. These are the companies making actuators, harmonic drives, and high-torque motors. Defense spending boosts their R&D budgets. As mentioned earlier, the dual-use nature of their technology protects their revenue streams. Even if consumer demand for robots slows down temporarily due to recession fears, defense contracts can keep these manufacturers alive and innovating. Third, we have the integrators. These are the famous humanoid brands. For them, the geopolitical climate is a marketing opportunity. They can position their robots as the solution to labor instability. Don't worry about strikes, don't worry about pandemics, don't worry about war disrupting your workforce. Our robots are here. This messaging resonates with enterprise clients during uncertain times. It accelerates pilot programs. Companies that were waiting 5 years to adopt robots might now move that timeline to 2 years because the risk of human labor disruption feels too high. However, a word of caution, not all humanoid stocks will win. In times of high interest rates and inflation, cash burn is dangerous. Investors should look for companies with strong balance sheets, existing revenue from non-robotic sectors, or significant government backing. The pure-play robotics startups are risky. The conglomerates that have robotics divisions alongside defense or industrial contracts are safer. The market is rewarding stability over hype. The Iran crisis is not a time for gambling. It is a time for hedging. Humanoids are the hedge. We are also seeing a rise in ETFs focused on automation and defense convergence. These funds allow investors to capture the trend without picking individual winners. As the narrative of physical AI gains traction alongside geopolitical news, these funds are likely to see inflows from institutional investors looking for exposure to the war on labor shortages. We must zoom out. The Iran-US tension is a current event, but the trend it reinforces is decades long. We are moving from a globalized world based on cheap labor and cheap energy to a fragmented world based on security and automation. In the old model, you built where labor was cheapest. In the new model, you build where production is safest. Humanoid robots are the key that unlocks this new model. They allow high-cost nations to manufacture goods competitively without relying on unstable foreign labor markets. They allow companies to maintain output even when human mobility is restricted by conflict or policy. Finance is ultimately about the allocation of resources toward the future. Where is the future going? It is going toward autonomy. Geopolitical conflicts simply act as accelerants. They burn away the complacency of the old system. Every time a supply chain is threatened, every time energy prices spike, the argument for electrified, automated labor becomes stronger. The valuation of humanoid companies is not just based on how many robots they sell today. It is based on the inevitability of their adoption tomorrow. The current crisis is reminding capital allocators that human-dependent systems are fragile. Capital hates fragility. Therefore, capital flows toward robustness. Humanoids represent robustness. So, the next time you see a headline about missiles in the Middle East or tensions in the Strait of Hormuz, do not just think about oil. Think about the factory floor. Think about the supply chain. Think about the robots that are becoming the only viable solution to keep the global economy moving amidst the chaos. The Iran crisis has not just made defense stocks valuable. It has highlighted the necessity of the humanoid revolution. It has turned automation from a nice-to-have into a must-have for national economic security. I want to hear from you. Do you think geopolitical tension will accelerate robot adoption, or will it cause a recession that slows it down? How are you positioning your portfolio for the age of physical AI? Let me know in the comments below. If you found this analysis valuable, please like the video and subscribe. We are building a community here that looks beyond the headlines to understand the true flow of capital and technology. Stay safe, stay informed, and keep investing in the future. I'm Alice, and I will see you in the next one.